Chapter 17, ETFs and Mutual Funds. As you may have picked up already, diversification is key in long-term portfolios. We will look more at diversification in Chapter 35. Exchange-traded funds, ETFs, and mutual funds are perfect for diversification because they are large combinations of paper assets. ETFs and mutual funds are almost exclusively created by large organizations that want to help you retire. These two fund types are going to be your best friend as a long-term, hands-off, research-light investor. Now, let's start with ETFs. As the name implies, buyers and sellers trade ETFs on exchanges during the market day. This means that you can buy ETFs through your broker that have tickers, bids, asks, and quotes just like stocks. Many brokerages have special agreements with ETF creating firms that allow you to purchase shares in an ETF without paying stock trading commissions. All ETFs may have management companies with investment goals. Some ETFs carry only stocks balanced around large index funds. Others cover market-specific sectors with a wide variety of companies. From the NASDAQ to wood, you can find an ETF for almost any market sector or index managed actively or passively by an investment firm. Since ETFs are managed by their investing firms, you never have to worry about rebalancing your portfolio when a new stock gets added to the S&P 500 index or an amazing new company emerges in a niche industry. Rather, your fund company will update their holdings as they see fit and let you know after the fact. Many investors successfully grow their retirements with index fund ETFs alongside sector-specific ETFs in fields that they know a lot about. Alternatively, you may elect to purchase the best-performing ETFs you can find. Whenever you invest in something for the long term that you know little about, be extra careful not to make overly emotional decisions in large market swings. Conversely, many investors feel fine holding their personal research long-term picks through downturns because they see value in the company or sector's long-term business or value propositions, perhaps based on technical analysis. It is always fine to invest based on facts and figures alone. Just remember to stick by your principles as a trader. To step up your long-term investing gain, research the best performing assets you can find. ETFs are great tools to use for diversified long-term investing because they drastically reduce the amount of time you will spend researching stocks alongside the commissions you will pay to buy them. For example, you will spend much less time buying the Invesco QQQ NASDAQ 100 ETF compared to researching all NASDAQ 100 stocks, purchasing 100 stocks, and modifying your portfolio quarterly in Invesco's case when the NASDAQ 100 changes slightly. Additionally, you only have to buy one ETF which may be available from your broker as a commissions-free trade rather than paying commissions on 100 unique stock purchases. This simplifies and lowers the cost of investing straight from your everyday paycheck. When an ETF management company opens a fund with the SEC, they outline their fund balancing plan for approval. Once an ETF receives SEC approval, the management company acquires bulk assets, or cash rarely, from large institutional investors that are held in a custodian bank. In this transaction, the large institution purchases ETF shares at the weighting specified in the SEC proposal or publicly disclosed holdings and weightings for actively managed ETFs released at the end of every market day. Institutional investors exchange shares in a like-kind exchange, giving up underlying securities and receiving the same value in new creation unit ETF shares. This exchange occurs at NAV, coming soon, only in extremely large blocks of ETF shares. These bulk transactions lower everyday operational costs of ETFs by stopping small individual shareholders from directly redeeming their shares for securities intraday. If an institution or anyone able to get enough shares to reach an ETF's block size collects thousands of ETF shares, then they can give them back to the ETF firm in exchange for the fund's underlying assets or cash, rarely. The fund gives the redeeming institution the lowest cost basis shares from its holding to lower the firm's tax liability. Institutional and individual tax liabilities are only dependent on ETF share price appreciation and dividend distributions. 4 new terms you should learn when looking at ETFs of any kind are net assets, net asset value, NAV, yield, and expense ratio. An ETF's net assets are cash fair market value, FMV, of all its stocks, bonds payable, realized gains, and cash less its liabilities, realized losses, and expense ratio fees. We'll talk more about fees soon. An ETF's net assets significantly increase when institutions give ETF firms new assets in exchange for new ETF shares and decrease when they redeem shares. Net assets also gradually fluctuate as markets move up and down, changing underlying asset FMV. Funds with higher net assets are generally more established and reputable. You should carefully investigate ETFs with low net assets, especially funds with short performance histories. Remember to look at the fund's overall long-term goals and see if it makes sense to buy the ETF instead of directly purchasing its underlying assets or creating your own portfolio. For actively managed ETFs, management firms must publicly publish holdings and weightings of their ETFs at the end of every market day. The net value from this report is used in place of an automatically calculated NAV used in infrequently rebalanced ETFs. To find the net asset value of a fund, simply divide its net assets by the number of shares outstanding. Generally, ETFs trade close to their NAV because that value represents the weighting adjusted price of the underlying assets represented per ETF share. Just like how a stock is part of a larger company, your ETF share represents a holding in a larger fund. When an ETF share trades above or below its NAV, you can sell or buy, respectively, the fund with greater certainty that the price will move towards the NAV. Many ETF firms and institutional traders maintain extremely tight margins by using computers to automatically buy or sell an ETF when it goes below or above a certain percentage value of a fund's net asset value. With these useful computer automated arbitrage ETF mechanisms, institutions can purchase bulk shares at market, increasing overall liquidity, and exchange them for profit with an ETF management firm when prices are below NAV. Similarly, these funds can buy bulk ETF shares at net asset value to sell when the market pays more than an ETF's NAV, bringing the fund closer to its true value. Slight deviations from an ETF's NAV provide enough profit incentive for most large management firms and institutions to practice arbitrage management techniques. This constant supply and demand pull between buyers, sellers, high-frequency traders, and institutions gives ETF prices backed by their underlying assets and near their true fair market value. As an investor, this practice helps your portfolio stay accurately valued and extremely liquid when you want to buy or sell ETF shares. With that said, many popular ETFs consistently trade slightly above their NAV because they are traded just like stocks, so high demand increases the price askers sell at. Actively traded index funds, market trackers, mutual funds, and ETFs alike are all difficult to time since the overall market in any sector is generally unpredictable. Additionally, these funds offer a few opportunities for high percent change price swings compared to individual stocks. For these reasons, you'll essentially never trade ETFs 9 to noon. However, these same reasons make ETFs a strong tool for long-term investing. Additionally, institutions with less emphasis on percent gains, perhaps firms with much more money to leverage, make money as a market maker or fund arbitragers to keep your funds performing as they should. An ETF's yield is a form of investment income, much like a stock's dividends. When stocks or other assets in an ETF pay dividends or interest income, the ETF pays out the cash to you based on the number of ETF shares you own. Check your specific funds to see how often they pay yield distributions. If most of the assets in a fund pay out quarterly dividends, then you can expect to receive quarterly yields that will add up to the total yearly yield percentage as long as you own an ETF. Though the ETF may own the underlying stocks for years before you buy the fund, the same qualified dividend and non-qualified dividend rules discussed earlier apply to your ETF as if it was its own common stock. See Chapter 15. ETFs with higher yields are great for your portfolio, but remember that you will pay taxes on dividend income, but not unrealized gains. This does not matter in most tax-abated retirement plans. Look for good long-term growth opportunities with ETF appreciation and yield payments. Yield payments are generally great for reinvesting into new assets just like dividends. Finally, we get to the cost of owning ETFs, net expense ratios, gross expense ratios minus abatements. ETF firms charge investors annual net expense ratios over the course of the year, spreading out the fee into every day's net assets and NAV. These expense ratios are given as percentages and are subtracted from an ETF's annual gain or loss. For example, if an ETF charges an expense ratio of 0.25% and appreciates a straight line by 10% in a year, then a $100 investment will turn into $109.75. However, you do not directly pay this 25 hundredth percent expense ratio to the ETF fund. Rather, the fund firm gradually lowers the ETF's net assets and per share NAV every day by 0.25 divided by 365 equals 0.0006849315%. An ETF or mutual fund can sell assets in order to generate the cash necessary to pay expenses if there is not enough dividend income or leftover cash to cover expenses. You will always pay net expense ratios no matter how a fund performs in a given year. Net expense ratios are generally lower for long-term, passively managed funds compared to actively managed ETFs. Look at a fund's historical performance to see if investing in an actively managed fund could yield you a higher long-term return compared to index funds or sector trackers. You should try to minimize ETF expense ratios whenever possible unless a higher cost fund yields higher returns because of its superior management. If you want to avoid fees altogether and take control of your investments, stick with your own diversified portfolio. Before ETFs came around, mutual funds were one of the easiest ways to invest in America. Mutual fund companies create a wide variety of funds based around large market sectors and major indices. Money market funds are a type of mutual fund that primarily invests in guaranteed low return investments. See Chapter 3. Mutual funds pool money from many investors, creating a greater overall portfolio shared with you based on your cash stake in the fund. By pooling your money with other investors, mutual funds give you the same diversification benefits, time-saving management, and low trading fees that ETFs offer. However, mutual funds operate much differently than ETFs. The two main types of mutual funds are open and closed-end funds. In an open-end mutual fund, you send your money to pool firms that issue you redeemable shares. These shares are purchased in cash and valued at the fund's NAV at the close of the most recent trading day. If you decide to sell your mutual fund shares, the management company must buy them back from you at the last trading day's closing NAV. Because you cannot trade an open-end fund intraday, these funds are almost exclusively geared towards long-term growth. In fact, many funds require you to submit purchase orders before a trading day's closing price has been determined, forcing you to estimate your entry point based on the overall market's daily movement before you actually know the fund's daily closing NAV. You buy open-end mutual funds with cash and receive cash when you sell your fund stake, just like ETFs. Investors can buy and sell mutual fund shares at any time, so the management company must always keep cash on hand to buy back fund shares. Additionally, funds may have to sell positions to pay for share redemptions. When individuals exit a fund, share selling can result in capital gains or losses that become your tax liability. In fact, almost any fund management creates tax liabilities for you, even if you never sell your fund shares. Realized capital gains for the entire fund are passed on to you to pay taxes on at least once a year. For example, a fund could collectively purchase Wind Resource Limited stock at $60 in 2016. Then, you decide to purchase the fund in 2018 when WYNN costs $180. A few months later, your fund manager decides to sell Wind stock at $195. The fund's net gain and tax liability is based on the 2016 entry point at $60, not your individual entry point into the fund. The mutual fund is now responsible for paying long-term capital gains gains tax, and managers must pass all tax liabilities on to fund participants at least once a year. So you'll be responsible for the fund's long-term capital gains on win, even though you missed out on most of the growth. Tax responsibility is split up depending on how many fund shares you have. Remember, the fund's yields, dividend income, or bond interest is generally taxed as income to you. Watch out for open-end funds with large unrealized gains when you enter them, as stock selling could cost you capital gains taxes before you start making money. Fund managers often lower annual shareholder tax liabilities by selling losing positions to offset gains. Some individuals also use this strategy to lower their tax burdens. Say you have $10,000 in realized long-term capital gains on your win trade. You can sell off some losing long-term positions that will have a taxable loss of $10,000. Suddenly, you owe no long-term capital gains taxes because your taxable net long-term gains are $0. You can even carry over losses from one year to the next by deducting up to $3,000 per year, $1,500 if married filing separately, from individual net income or dividend payments, 2018. You can exclusively sell off long-term losses to offset long-term gains or liquidate short-term losses to offset short-term gains. Mutual fund managers can settle unrealized losses in the same manner to lessen an entire fund's overall tax liability. While losing money to save money may sound counterproductive, remember that you would have the same unrealized loss in your account anyway. Although it is generally best to leave long-term picks alone when the year ends, you can sell stocks for a loss to limit taxable gains and use that money to purchase other stocks in the same industry sector. You can even buy the same stock after a month passes, pursuant to the IRS wash sale rule. The wash sale rule does not allow long or short-term capital gains liability deductions from losses when you sell for a loss and buy the same stock or a substantially identical security back within 30 days of the sale. If you do choose to sell a position and purchase other stocks in the same industry sector while avoiding the wash sale rule, just make sure you do not accidentally cut off long-term gains. You do not want to terminate a temporarily down position for better short-term tax treatment if you still believe in the underlying company. Paying taxes when you do not have any losses to wash away gains is a good thing. Open-end mutual funds act more like pooled investment groups than ETFs. You invest cash with others and share all tax liabilities and interest with mutual fund. You exit the fund by asking for your per share NAV back in cash after all the fund's assets settle after a trading date. Mutual funds generally carry significantly higher net expense ratios than ETFs because of the more involved management required to keep passed on tax liabilities down, selling investors paid in cash, portfolios balanced appropriately, and other expenses paid off. You can expect even higher expense ratios with smaller valued or more actively managed funds. Net expense ratios are deducted passively from mutual funds' net assets to cover operational costs, just like ETF expense ratios. In addition to annual expense ratios, some funds charge front-end and back-end loads, otherwise known as fees. These funds charge you percentages of your investment whenever you buy into front-end or sell out of a fund back-end, hurting your overall returns. If a fund outperforms the market significantly, these fees may be negligible in the long term. However, we already know about the power of compound interest, and even the small fees can have significant effects on your portfolio down the line, as shown below. Always search for high-performance funds with low net expense ratios and loads. For mutual funds in particular, watch out for net expense ratios that gradually rise depending on how long you own a fund. If a fund charges high load fees or perhaps miscellaneous annual 12b1 fees, make sure you get a higher return for the managerial investment you make. And then we have a chart, and we can see assuming an 8% annual return, with an initial investment of $20,000 in each of our three examples, we have a 0.29% expense ratio, a 1.22% expense ratio, or a 0% expense ratio, which would represent your portfolio. Right around now, 0.29 is pretty average. That's managed ETFs, not necessarily the index ones. Index ones are usually lower. And then mutual funds around 1.22 is something you'll see pretty common in the mutual fund market. So if we look at after 5 years, 10 years, 15 years, 20 years, and 40 years, we see significant price changes in the dollar value of your portfolio. Essentially, you're just going to have that same 8% annual growth, but minus the expense ratios for the first two funds. And then if you have your own portfolio, you're not going to have that expense ratio at all, and that's reflected in the capital growth of all the funds. And by the time you're at 40 years, we can see that managing your own portfolio yields $434,490, whereas with an 8% expected annual return, the 0.29% expense ratio yields $390,185, whereas the 1.22% expense ratio yields $275,821. So you're going from $435,000 to $275,000, and all that is a change of a 1.22% expense ratio compounding annually over 40 years. So it's a pretty freaking big difference, and that's why it matters. Most mutual funds are open-end funds that issue shares to the public after every trading day at NAV. With that said, some closed-end investment funds only issue shares to the public once. These shares are then traded in between investors like ETF shares and are not repurchased by fund issuers, which means that they can be traded intraday. However, these funds generally have little to no arbitrage mechanisms in place, so the market prices can drastically differ from NAV. Closed-end mutual funds mechanically function similarly to open-end funds. Dividends and interests are paid out as ordinary income distributions to shareholders, net expense ratios are taken from net assets, and net realized capital gains are passed on to shareholders at least once a year. Just make sure any fund you purchase has ample liquidity and a strong price history near its net asset value. Watch out for leveraged mutual funds and ETFs that increase shareholder risk and potential returns by using debt to finance positions. Some leveraged mutual funds charge their expense ratio against total assets, including invested debt, raising their effective expense ratios or hidden 12b1 fees. One last investment vehicle you may see are unit investment trusts. These funds make a one-time public offering for a fixed number of securities, which are forcefully sold on a specified termination date. The management company never alters the positions in the fund after the sale, simply leaving the assets to grow unmanaged and generally with very low expense ratios until a sale date when managers liquidate all positions and redistribute the profit and losses to shareholders who can trade the fund until termination in the secondary market. These assets are notably rare but useful pre-made static long-term portfolios that you can buy with only one convenient order. By purchasing ETFs or mutual funds, you can significantly lower your long-term risk and volatility by diversifying across a broad range of stocks and industries. Monthly contributions to these funds require minimal management commitments or research on your part. Large institutions operate diligently daily to ensure you have access to top-rated funds on liquid exchanges, making it easier than ever to purchase a slice of the American economy.